Hello, everyone, and welcome to Next Generation Business School. We are here to inspire and equip the business and finance leaders of tomorrow. My name is Amin Shakulwan. In this channel, we explore the depths of accounting, tourism management, financial strategies, business tactics, and economics theories. Join us as we uncover the best strategies to help you thrive in your studies and future careers. Please make sure to like, comment, and subscribe for more valuable contents. And let's build your future with the power of knowledge and the drive to success. Your transformation starts here, so let's start together. Okay, in continuing to the basic accountings, we want to focus on external financial reporting in this session together. In fact, we want to discuss the key objectives of external financial reporting, and understanding this objective is important because they explain why business prepare and share their financial information with external users. So let's break down this objective. So the first objective is provide financial informations in our first priority. Provide specific informations about economic resources, claims to resources, and also changes in resources and claims. This objective focus on delivering detailed informations about a company assets that have economic resources roles, liabilities that claims to resources, and also equity, as well as how this element change over time. This information are important because help external users understand what the company owes, what the company owns, and the owner's equity interest in the company. For example, financial statements like the balance sheet shows the company assets, for example, cash, inventories, liabilities, for example, loans, accounts payables, and also equity at the specific point in times. Changes in these accounts are highlighted in reports like the statements of the change in equity and providing a comprehensive view of companies' financial positions. In the next steps, we want to focus on the next objectives, provide information useful in assessing amount, timing, and uncertainty of future cash flows. The objective in this level is about giving insights into the company's potential to generate future cash flows, the timing of these cash flows, and any uncertainty surrounding them. These objectives are important because investors and creditors need this information to evaluate the company's ability to generate cash to meet its obligations, pay dividends, and invest in the business. For example, the cash flow statements provide a detailed view of cash inflows and outflows from operating, investing, and financing activities. And it helps external user predict future cash flows by showing past cash flows, patterns, and the resources and the use of cash. And finally, in the third levels, we arrive to provide the general information that is useful in making investments and credit decisions. This objective focuses on offering broad, vital financial information that assists the user in making informed decisions about the investing or lending to companies. This objective is important because accurate and comprehensive financial information helps investors and creditors decide whether to buy, hold, sell their investments or extend credit to the company. For example, the income statement and other financial disclosures help users evaluate the company profitability, performance trends, and also potential growth, and enabling them to make sound investment and credit decisions. Ratios derived from these statements, like the debt to equity ratios and return to equity, provide further insights into the company's financial health and risk profile. So, generally, the primary objective of external financial reporting ensure that all stakeholders receive relevant and reliable information to make informed economic decisions. By understanding the company resources, predicting future cash flows, and evaluating overall financial health, external users can better assess risk and opportunity. After explaining about the objective of external reporting, we arrive to the primary financial statements. In fact, we want to continue discussing the objective of external financial reporting by exploring the primary financial statements. These statements are the core of financial reporting. This is very important part of accounting basics. So, these statements are the core of financial reporting and providing essential information to external users. So, let's break down these primary financial statements. As we can see, we have three different primary financial statements. First is balance sheet, second, income statement, and third, cash flow statements. So, balance sheet. In the balance sheet, that also known as the statement of financial positions, we can provide a snapshot of company's financial condition at a specific point in time. This financial statement is important because it shows what the company owns as an assets and what it owes as an liabilities, and the owner's equity, giving external users a clear view of company financial stability and liquidity. For example, assets include cash, inventory, property, and equipment. Liability includes accounts payable, loans, and other obligations. And equity represent the owner's residual interest in the company assets after deducting liabilities. The next part or next financial statements is income statements. The income statements, also known as a profit and loss statements. The income statements or profit and loss statements or profit P&L statements. So, the income statements or profit and loss or P&L statements shows the company financial performance over a specific period, typically a quarter or a year. These financial statements is important because it details the company revenue, expenses, and profit or losses, that providing insight into the profitability and operational efficiency of the company. For example, we have revenue in financial statements, in income statements. We have sales revenue and service income. We have expenses in income statements that includes cost of goods sold, operating expenses, and taxes. Also, we have net income that is the difference between total revenue and total expenses. And finally, in the third financial statements, we arrive to cash flow statements. The cash flow statements provide a detailed view of the company's cash inflow and outflow over a period specific in the time. The cash flow statement is important because it highlights the company ability to generate cash to meet its obligations, invest in its operations, and also return value to shareholders. It is divided into three sections of operating activities, investing activities, and financing activities. So cash flow is divided to the three sections: operating activities, investing activities, and finally, financing activities. So, what we show in operating activities? The operating activities that is cash received from customers and cash paid to suppliers and employees. Investing activities includes purchase or sale of long-term assets like equipments and investments. And financing activities is issuance or repurchase of shares, borrowing and repayment of the debts. Generally, the primary financial statements, balance sheet, income statements, and cash flow statements are important tools in external financial reporting because they provide comprehensive insights into the company financial health, performance, and cash management. And understanding these statements allows external users to make informed investments, lending, and business decisions. In the next step, we arrive to characteristics of externally reported informations. When a company share financial information with investor, creditors, and also other external parties, it is important to recognize certain characteristics to make the most out of this data. Let's start with the first characteristic, and this is a means to an end. This means that financial information isn't just a number on a page. In fact, the financial information it serves a purpose and it helps stakeholders make informed decisions about the investment, loans, and other financial matters. Next characteristic is beyond statements. In the three second levels, we arrive to beyond statements. And this is financial reporting goes beyond just presenting financial statements. It encompasses a broader range of data and disclosure aims at providing a comprehensive view of the company financial health. The third characteristic is historical perspective. In fact, external financial information typically reflects past performance rather than future projections. It offers insights into the company's financial history, helping stakeholders understand its trajectory. Characteristic number four is precision versus estimates. In fact, why financial reports may seem precise, much of the data is based on estimates, judgments, and assumptions. These factors play a significant role in shaping the financial pictures, both past and future. Characteristic number five is general purpose informations. In fact, companies aim to provide general purpose informations that caters to the needs of various stakeholders, including investors and creditors. This ensure that the data remains relevant and useful to the wide range of users. And finally, we have management explanations. That is, includes explanations from management enhances the value of externally reported financial informations. These insights provide context and clarity, helping stakeholders interpret the data more effectively. By understanding these characteristics, stakeholders can better interpret and utilize externally reported financial information to make informed decisions about the company and they invest in or do business with. User of internal accounting informations is the next topic that we want to discuss with together in these sessions. Internal accounting information is vital for decision making within an organization. So let's explore the various users who rely on the informations and their roles. The first user of accounting informations is board of directors. The board of directors is the governing body that responsible for overseeing the company's strategic directions and ensuring accountability. The next user of internal accounting information is Chief Executive Officer or CEO. In fact, the Chief Executive Officer or CEO is the top executive responsible for the overall management and performance of the company. Next user of internal accounting information is Chief Financial Officer or CFO, that are the executive responsible for managing the company's financial operations, reporting, and compliance. User number four are vice presidents. They are senior executives with specific responsibilities in various departments, such as make marketing operations or human resources. And number five is business unit managers. They are managers that are responsible for overseeing specific divisions or departments within the company. User number six are plant managers, the managers that are responsible for the operations and performance of the manufacturing plants or facilities. Store managers are the next stakeholders, the managers that are oversee the operations and financial performance of retail store or outlets. The final users of internal financial informations or accounting information are line supervisors. They are frontline managers responsible for supervising and coordinating the activities of workers on the production lines or in service areas. Understanding the roles and needs of these internal users is important for effective internal decision making and performance managers. And the final part that we want to analyze it with together is objective of management accounting informations. We have two main objective of managing accounting information is to help achieve goals and missions in the first level objectives, and in the second level we have to help the evaluate and reward decision makers. So let's start with together the first important objective of management accounting informations to help achieve goals and missions. In fact, management accounting provides insights and data that aid in aligning organizational activities with its broader objectives and missions. And in fact, by analyzing financial and non-financial information, management can make informed decisions to steer the company towards its strategic goals, and it includes setting performance targets, allocating resource effectively, and also monitoring progress towards objectives. The next and second objectives is to help evaluate and reward decision makers, that is management accounting information facilitates the evaluation of decision makers performance and supports reward systems within the organizations. By measuring and analyzing performance metrics such as profitability, efficiency, and also productivity, management can assess the effectiveness of decision made by managers and employees, and this evaluation helps in recognizing and also rewarding individuals or teams that contribute to the organizational success, fostering motivations and accountability. Understanding these objectives of management accounting informations is crucial for organization to leverage data effectively in decision making and performance management process. Thank you for your watching, and please don't forget to like, subscribe, and hit the notification bell for more highlights into accounting and business managers. So let's continue learning together in next class and next session with togethers of accounting basics.